Good morning, everyone. Let me get my mic here in place. Today is January the 14th. I want to take a look this morning at some charts and information I've been looking at as far as the general market conditions. We'll take a look at the VIX and the heat map. We'll do a comparison of how the SPX is holding up against the equal weight. We'll look at offense and defense and see how they're comparing. We'll look at the major indexes, and then I want to spend some time looking at the banks because they reported starting yesterday with JP Morgan. And then this morning we had Bank of America, Wells Fargo, and Citi should be reporting just any moment. So we'll get started with a general market overview of how things performed yesterday. The Dow was down about 0.8%. The S&P 500 was down 0.2%. The Nasdaq was down 0.1%. The mid cap was the only major index that was up, and it was up 0.2% yesterday. Small cap was down just a bit, and we did see the VIX creep up just a little bit. If we look at the sectors overall, we were pretty defensive yesterday. Energy is somewhat of a neutral sector, but it was up the most at 1.42%. Consumer staples, real estate, and utilities are all defensive sectors, and they were up 1.16% for consumer staples, 0.76% for real estate, and utilities were up 0.63%. Industrials are more of an aggressive sector, and they were up 0.5%. Basic materials is neutral sector, and they were up just shy of 0.5%. And then we see our more aggressive groups. Technology was down nearly 0.25%. Consumer discretionary was down 0.25%. Healthcare was down 0.41%. Communication services were down a little over 0.5%. And financials really took the brunt of the market activity yesterday and was down nearly 2%, down 1.192%. Then if we look at the overall, we'll take a look at the yields on the bonds. All the long ends yields were down. So the 10-year came in at 4.17. Yesterday it was down 0.38% on the yield, and the short-term yields were up about 0.75%. We'll take a look at the major indexes. The small cap, this is for 1 week. Maybe we should just go into just one day and we'll take a look at it that way first. So the semiconductor index was up nearly 1%, followed by mid cap at 0.19%. The equal weight was up 0.01%, despite the S&P itself being down 0.2%. Small cap was down. The Nasdaq was down. Transportations and industrials. Then if Dow Jones Industrial. And then if we look at 1 week, we can see that the small cap has performed the best over the past week at 1.37%, followed by semiconductors at 1.27%, mid caps at 0.84%, the Nasdaq at 0.4%. The equal weight once again outperformed the cap weighted S&P by 0.9%, 0.09% or so. And the industrial average Dow Jones was the only one that was down over the past week. Want to switch over and look at the SPX. We'll take a look at this put call ratio. But we did set a high on the 12th, and we were down yesterday 0.19%. We had seen a little bit of a downtrend in the put call ratio, but that is starting to move back up. And we did see the raw data get up to 0.69 yesterday. We had been as high as zero point 0.9 on the 31st of December. Then if we go and look at the VIX, the VIX had reached a low on December the 24th, getting down to about 13.47. That has been moving up higher. We're still in a pretty good zone. I start becoming a little more cautious when we get above 20, but we did reach up to 15.45 on the VIX. Means that insurance, if you want to buy puts, if you're anticipating any kind of a downturn, the cost of that insurance is actually pretty cheap at the moment. We'll take a look at the market carpet or the heat map. This is over the 1 day. We can see that some spots in technology actually did pretty well. Comm services, we had Google do pretty well. Meta fell 1.69%, and the rest of the companies in that performance particular sector were pretty much down. Financials took the biggest hit. I see that we had one company, the CME group, that was green, and the CBOE. So those are both involved in exchanges. I think they're exchange companies. Bank of New York Mellon, they reported yesterday. That's not one I'll focus on today, but they actually closed the day up. And then I thought I saw one more, but I don't. Discretionary was down for the most part yesterday, with Amazon falling 1.57%. Healthcare was somewhat mixed. J&J did move up 1.87%. We had energy that did really well overall. Materials looked like they did really well overall. Real estate looked pretty good yesterday. Utilities, the industrial group, somewhat mixed, but overall did pretty well. And consumer staples also did pretty well in a defensive moving market. I want to take a look at how the equal weight is performing compared to the cap weighted. That's this chart here. So we can see that the SPX has pretty much been moving up and to the right. The RSI is sitting at 60 at the moment. We are in a buy signal on the daily view. Money flow is positive. But one of the interesting things here that I see is it has been underperforming on a relative basis compared to the equal weight S&P 500. So that somewhat indicates to me that people are moving more from the growth into the other parts of the S&P, the 493. So that's been on a downtrend pretty much since the end of October. We can also take a look at the offense versus defense. So these are all relative measures. The first one we'll look at is the QQQ compared to the S&P 500. The QQQ has more growth in it compared to the S&P 500, although a large portion of the S&P 500 is growth. But one of the interesting things, once more, that we see is this overall general decline from growth to the other parts of the S&P 500. We also see that on the discretionary versus consumer staples, although not quite as drastic. When we look at the large cap growth compared to the large cap value, we basically see that same trend where the momentum seems to be in the favor of value over growth. This is mid cap growth compared to mid cap value, and we see that same exact trend. Then once again, small cap growth compared to small cap value, that same general trend. Technology versus utilities, we're actually seeing somewhat of an opposite trend, but overall, we do see that growth seems to be less favorable at the moment than value overall. So next we can turn to some of the banks. So JP Morgan reported yesterday, and I'm getting some conflicting information on this. I'll explain what I'm talking about here. Let me get a little sip of water. This particular report says that JP Morgan beat on both the top and bottom line. But then if I move over to their actual earnings page, it says they missed. So I'm going to have to go and investigate JP Morgan a little bit more and see which of these two are actually true. I did look at JP Morgan yesterday. They were down after their report by 4.19%. It does look like they are going to be down also this morning, just slightly. And if we look at Bank of America, they reported and they beat on both the top and bottom line. Revenue is up 7.2% year over year. And then if we look at Wells Fargo, they also beat. Their revenue increased 4.5% year over year. Although they did miss on the quarterly, according to estimates, they missed by 390. So the next one that I'm looking for is Citigroup. That's actually one that I own. Looks like they have reported this morning, and they beat on earnings by 19 cents, and the revenue they missed by 580 million. So their revenues were 19.9 billion in the fourth quarter of 2025. That increased 2% on a reported basis, driven by growth in banking services, their proprietary, no, I can't remember what that is, USPB. Oh, and wealth, that's their wealth group. Primarily offset by a decline in all other. And this was excluding the Russia related item that they had to write down to exit the banking business in Russia. That's one of the last banks that they had planned to exit, and they finally were able to exit that last year, end of last year, but they did have to take a pretty big write off. Their provision for credit losses was 2.2 billion, driven by higher lending activity. Offsets in credit quality. Net credit losses were down 2% from the prior year, so that sounds good. One of the things I wanted to also see is if they released any information about their okay, reported fourth quarter earnings. So let's go look at their full year results. Okay, let me make this a little bit bigger for us to see. So this is January the 14th. So revenues increased 2% from the prior year on a reported basis. Net income was 2.5 compared to 2.9. Let me see how they're doing in the pre-market right now, because some of this is not sounding too terribly good at the moment. Whoops, that's not what I wanted. Okay, so they're actually up. They were down yesterday, and most of the financials, especially the banks and credit card issuers, they were down on Trump's comments about capping interest rates on credit cards to 10% for a year. So that hit all of the credit card issuers yesterday, and even some of the like MasterCard and Visa, even though they don't hold the credit, they only perform the transactions. Even they were down slightly. Citigroup is down 1.2%, so much less than JPM yesterday. And Citi looks like they could be up this morning. So let's go back to earnings per share decreased. I knew they were going to have that one write off. This is excluding Russia related notable item revenue of 86.4 billion, and their Bank of Mexico goodwill impairment they also had to take. Hopefully those are one-off charges to exit those businesses, and then they can really start moving forward now that they're focusing on the more profitable areas of the company. So total revenues compared to the third quarter looks like they were down. Looks like they were up slightly from a year ago. So down 10% quarter over quarter and up 2% year over year. Their book value per share has gone up from the last quarter. So the last quarter it was $108.41. That's what I'd been reporting in my videos on Citi. So it looks like the book value has increased 1% quarter over quarter and 8% year over year. So last year they were at a book value per share of $101.62. Tangible book also increased 1% quarter over quarter, 9% year over year. Return on average common equity looks like it's actually down a bit. I think they're trying to bring that to about 10% overall, so that's not progress in the right direction. Okay, their net income was 2.5 billion in the fourth quarter compared to 2.9 billion a year ago, driven by higher expenses and limited tax benefit of the Russia related item. They did report a dividend this morning as well, 60 cents per share that'll be paid out on February the 2nd. Net interest income 3.3 for the fourth quarter compared to 3.1 for the third quarter and 2.8 for last year. So that's a 6% increase quarter over quarter, 16% year over year. Services revenues were up 11% for the quarter. So that's good news. And 15% year over year. And their net income was up 25% quarter over quarter and 20% year over year. So they are definitely making progress in the services area. Okay, this is their markets. Total markets revenue were down 18% quarter over quarter, 1% for the year. Net income in this business was down 50% quarter over quarter, 22% year over year. Then their banking business was up 7% quarter over quarter, 92% year over year. So that's good. And their wealth business, they were down 10% quarter over quarter and up 1% for the year. This is an area where they do have an opportunity to really grow over the next couple of years. This is personal banking down quarter over quarter, but up 116% year over year. Okay, I don't see anything about buybacks. That was another thing that I was really looking forward to hearing since they had the amendment by the OCC lifted in December. That was going to give them an opportunity to start buying back shares. Let me just do a quick search for buybacks. Okay, that's the only mention of buybacks that I see. I'll have to research that or listen to their call to get any additional information on that particular topic. So we can close this out. We'll take a look at Citi once more in the pre-market. So they're up a little over 1% at the moment. Let's compare that to JPM. They're still down. We'll take a look at BAC, Bank of America. They're down 1.5%. And WFC, Wells Fargo, they are also down in the pre-market. So Citigroup, um, looks like investors are pretty happy with the earnings report overall. Hey, Shadow Guy, good to have you here. So we've taken a look at the banks. We can look at them in fast graphs real quick. So JP Morgan is trading above fair value according to fast graphs. They do have an EPS yield of 6.4%. So they are trading pretty much over their uh, book value. So this is a screen that I have set up so I can keep track of these big banks and how Citigroup in particular compares on the price to book ratio and the price to tangible book. So Citigroup was at 1.1 when I did my earnings preview on Sunday because of the rhetoric or talk about capping interest rates. All the banks have dropped a little bit. So they're down to 1.7. But if you look at these price to book ratios, Citigroup is the cheapest according to that particular ratio. And I'm pretty convinced that if Citigroup can make the improvements that they've promised, and they've actually demonstrated they can perform, that we can see Citigroup trade at a book value that is much closer to these banks and would lend to higher prices towards the end of next year. So if we go back to fast graphs, we can take a look at Bank of America. I haven't actually looked at them before in fast graphs. So they're trading a little bit above their fair value and below the typical market multiple. And it looks like that's where they pretty much traded for the last 12 years or so. They have an EPS yield of 7%. That indicates pretty good value. They have a dividend yield of 2.05%. Then we'll look at Wells Fargo. They're also trading right around fair value. They're sitting at 14.78. Fastgraphs has them calculated at 15 times. Their normal market multiple is slightly below that at 14.34 times. They have an EPS yield of 6.77%. Once again, indicating pretty good value. Their dividend yield is 1.92. And then we'll take a look at C. I also included this in my video over the weekend. So this will be a little bit of a repeat of that. They have an EPS yield of 6.77%. So all of these banks appear to be a pretty good value, despite where some of them are trading in relation to their price to book ratio. They have a dividend yield of 1.92% at the moment. So all the banks look pretty fairly valued. Just keep in mind that price to book. That's typically how we value these. And JPM is the highest on that particular ratio. So they appear to be a little bit overvalued there. But as far as Fastgraphs is calculating their intrinsic value, they're pretty much right at fair value. So let's see if I have anything in my notes. We talked about the rotation into some of the let me get this phone call here. Okay, so let's go to some charts that I've been looking at this week. Yeah, let's take a look at how some of these companies are actually changing, or investors are looking more at value, defensive or value right now. And that is not one that I thought it was looking better than that. Here's Hershey. So Victor wasn't able to live stream today. He's working on a issue problem that he's had at home with some plumbing, so he's not able to join today. So I was really interested in seeing what City did, so I decided to go ahead and live stream without his wisdom today. We'll get those restarted here before too much longer. So hopefully that answers your question, Scott. So Hershey is not far from 52-week high. Let's see what I'm looking at here. I just want to go to 1 year. So they are trading at a 52-week high. So this is a consumer staple that had been down as low as 135 back in February. They've been hit pretty much by cocoa prices. I've seen them as high as 255 within the last 3 years. But they've been hit by those cocoa prices, but they are, despite that, at a 52-week high this week. So looks like investors are rotating away from more of the aggressive groups into some defensive areas. Another defensive area would be the REITs. And you can see how uh, NNN REIT has moved from about $39 up to 41. So they're up about 7% over the last 2 weeks. I also posted in the Discord about realty income. That's another defensive area of the market. They have highs of about 60 overall. You can see they're not very far from that at the moment. So over the past 2 or 3 weeks, they're up about 6.33% so far. The RSI is looking good, and the PPO is also in a buy configuration at the moment. We can take a look at Rocket Lab. This is not defensive whatsoever. This company is not even profitable yet. I may have a specific chart on them. Let me go and look. Yeah, because basically based on this cup with handle pattern right here, so you can see the cup, you can see the handle, and we had a breakout. I calculated a price target based on the level at this rim, right rims, down to the bottom. Calculated a price target of $89, which it has hit within a dollar. It's sitting at 89.87 was the high, sitting at 86 right now. So that cup with handle pattern did perform very well. Couple of ETFs that I thought were interesting. This is the small cap ETF. And over the last, we look at 5 years, they had really struggled for a long time. They had the big dip back in April with the tariff announcements, but you can see that they are up 51% since the April lows. So these small caps, and this is more like the small cap 600. So this particular ETF excludes companies that are not profitable. So I like this to look at this one, and I own this one compared to like the IWM, which is the Russell 2000, which includes unprofitable small caps. Let's look at the SCHD, which has also been struggling for a while, but is really starting to break out at the moment. So you can see over the past 9 months or so, they pretty much just traveled sideways, but we are seeing quite a rise since December as investors are moving more from growth to value and dividend payers. And the last one I want to look at is SCHY. This is the international version of SCHD. And you can see how much better over the past year it has performed compared to SCHD. This one's up 36% over the past year compared to the SCHD, which isn't really even close to that. Yeah, over the past year, they're only up about 8%. So anyway, that's what I had on my agenda to cover this morning. Do you guys have any charts you want to look at before we close the live stream? If not, that's it for me. I appreciate you guys tuning in. I wish you the best of luck this week with your trading, and we'll talk to everyone later. Have a good one.